Welcome everybody to Safe Option Strategies presentation of sentiment analysis. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. All right, this is one of the most interesting classes I have ever had the privilege of teaching. It is one of the most interesting classes I was ever taught, and this goes back well over a dozen years ago that I first got a look at this information and the relevance of it, and I'll tell you right now that sentiment analysis is probably the most overlooked thing for traders, investors, day traders, get-rich-quick people, long-term traders, whatever style of trading you follow or like. And obviously, if you're here in this class, you're learning the Safe Option Strategies way. But very few people pay as close attention to sentiment analysis as they should. It's not by itself the key to everything. It's one important piece of the overall puzzle that makes us the best traders we can possibly be. You've heard me talk before. If you've listened to any one of my presentations before, you've probably heard me talking about seeing the forest through the trees. The interesting thing about this concept of seeing the forest through the trees, the whole premise to that saying is you've got to see the whole picture. You can't get hyper-focused on any one little thing that could distract you from seeing the big picture. And the interesting thing about sentiment analysis is it is one thing. It's one tree that helps make up the forest, but it's an important one. It's not, if you leave it out of the picture, you're just not as well educated on the educated guesses you are going to make. And that's what all of trading is. Everything we do in trading is making educated guesses, but we want those guesses to be as educated as they can possibly be when we trade. So what is sentiment analysis? Let's talk about what this comes right out of Investopedia.com, market sentiment. The feeling or tone of a market, i.e. crowd psychology. It is shown by the activity and price movement of securities traded in the market. Now, if you take that definition on its surface, you could create a pretty broad way of looking at this. Of course, price movement is going to be a reflection of what the sentiment was, but we're trying to figure out how do we gauge the sentiment ahead of time so we have a better educated guess on what that price movement might be. How do we measure sentiment? And how do we use that information to our advantage? That's what this class is going to cover. This is not a real long class. This is a class that deals a lot with philosophy and less with the nuts and bolts mechanics of things. I have a lot of engineers that have found their way to Safe Option Strategies over the years, and they're nuts and bolts type of people. I want to know exactly if A happens and B happens, how do I make C happen? And sentiment analysis doesn't quite fit that engineering type mold. It's more a matter of how do we measure the pulse? How do we measure the tone? How do we get inside the minds of people that are going to move the market and take advantage of it? That's what we're going to cover. So how do you measure market sentiment? There's a few different ways we can do it. Put-call ratios is one of those ways. We'll talk about that. We're going to talk about the VIX. We're going to talk about general market conditions, and we're going to talk about world events and news events. And then we're going to have a little bit of a philosophical conversation about common sense. And how do we, and it gets left out of too many things nowadays. Too many things going on around us in the world seem to leave out common sense. And so we're going to talk a little bit about that, how that weighs in. Let's talk about put-call ratios. Does anybody here know what put-call ratios are and how they affect trading? Does anybody have some insight for us on put-call ratios? The CBOE posts put call ratios at the end of every week of trading, and this is the website that you can go to find put call ratios. Now, Julie says she has a friend who majored in common sense. I love it. Okay, put call ratios show us the number of long puts to long calls that are ordered, not necessarily filled. Put call ratios do not tell us the number of orders being filled. They tell us the number of orders being placed on puts versus calls, generally speaking. Now, this is interesting. A number of less than 1.0 reflects fewer put orders than call orders, and a number above 1.0 reflects more put orders than call orders. So we'll look at some examples of this. Now, this is the part that you have to pay attention to. If you've never looked at put-call ratios before, here's where the fun part is. A ratio of 0.85 is considered neutral market sentiment because more people understand and use long calls, and there is a built-in expectation that there will be more long calls ordered on a typical day or a typical week. Let me show you an example of this. And this is from earlier in the year. I didn't take the time to grab brand new data from just recently. At the time we're recording this, this information is maybe 6 or 8 months ago, but that's okay. This illustrates the point that I want to make. Right here, we see a relatively even or a relatively neutral put-call ratio. What this number means right here, and we said, remember we said 0.85 represents a fairly neutral sentiment. This number of 0.86 means that for every call option, every long call option ordered, there were 0.86 long put contracts ordered. Does that make sense? For every long call contract that was ordered, there were 0.86 long put contracts ordered. This is just general for the whole market. Okay? That's a neutral ratio. Our built-in expectation is that more calls would be ordered, and that's what this is a reflection of. Okay? Here is a time period where a lot more long put contracts were ordered, and this would be a very bearish sentiment. Okay? If the number is higher, if the number is higher than 0.85, there's bearish sentiment. If the number is lower, then we're dealing with bullish sentiment. Okay? So the number of 0.85 or relatively close to, you could say 0.85, 0.8, 0.9, that's considered fairly neutral. Yeah, Julie said, can we please take a look at what the ratio is right now? Yeah, we can probably, before we're done with this presentation, I'll switch over to a live screen and we'll look at what the ratio is currently. I wouldn't mind doing that at all. All right, let's keep moving along. As with many indicators in the market, this is one indicator. And I mentioned this earlier, but I'll read it exactly the way I have it here. It needs to be put into the context of what the big picture is. Okay? Now, by the time we have these numbers, the time has passed, right? Is there such a thing as future data? Is there any such thing as future data? Anytime we're talking about numbers in the future, we're projecting based on data, and if we have data, it is in the past because the only way to have data is if it's already taken place. The only way to have these numbers is if these numbers have already taken place. Data, by definition, is past tense. It's previous information that we've gathered. Any numbers we're projecting out in the future are speculation. So what good does it do us to have sentiment on something that has already taken place? Tim's saying, with the example you're showing, would you consider this bullish or bearish? These numbers right here, this would be bullish because there are even fewer puts being ordered for calls being ordered relative to what we consider kind of neutral. We'll look at some current data. When we get to the end of the presentation, we'll switch screens. Let me see if I might be able to do that right now. All right, I'm going to ask if you'll, this is good, and I'm glad you're asking. This is why I love doing these presentations live. Bear with me for a moment. I'm going to, you don't see this going on because your screen is froze right now, but I'm jumping over to where we can take a look at put-call ratios. And I'll bring them on the screen, and we'll look at some current ones. It's good information to have, so let's go ahead and look at some current ones. Okay, so I'm gonna share this screen that I have that you guys aren't looking at right now. I just wanted to make sure. It's a possibility I had something open that I didn't want you to see. Okay, so so let me show you a couple things real quick here. Oh, you saw. Oh, Tim said we could see it the whole time. Okay, all right, that's okay. That's all right. I wanted to look more. I wanted to look better than that, Tim. I wanted it to look like, you know, I just could instantly grab that. You didn't have to see me fumbling around and doing searches. All right, I blew that. That's okay. All right. So here's where I got to, and maybe it's a good thing that you saw how I got to there. So here's the site that we ended up at, and that's the link that I had previously in the presentation, put-call ratios. Now here's how I look at this. Right here it says current, and this is going to be 111. I know this is really small on your screen, but we'll try and get it in a way that it's blown up and you can see it. I'm going to click on a link here that says 111 to present, total exchange volume put-call ratios. I'm going to click on this. Now it's going to ask me how I want to open it. I'm going to open this in an Excel document. And Excel's going to open up now, and initially, now off screen, I'm just shrinking this down to where it will show up decent on your screen, and I'll share this with you in just a moment. So let's have you look at the Excel document right now, and this is what just opened up for me. Whoops. I didn't want to do that. Okay, so this is the most recent data that we have, and as you can see, and take a look now, would these days right here coincide with some very bullish movement that we had in the market? And then we had a little bit of uncertainty in the long-term buying, and then we came back into, look at these numbers we've had right here. Oh, wait a minute. I'm clear back in 2006. Sorry. I've got to scroll. I forget. I've got to scroll all the way down. Okay, here's our most recent data. Sorry. Here is our most recent data. Sorry, and Julie, you caught that and pointed that out to me. Sorry about that. Let me see. This is the challenge of doing this stuff live, is I can fumble around a little bit. Okay, so couple of days. Look at how nervous. Now remember, these are orders. These are not necessarily orders that are filled. These are orders. Look at how bearish things were in the days leading up to our election, and look at how the pattern reversed a little bit. Now, there was still some nervous sentiment, even though the markets were pushing higher. There was still some nervous sentiment. But look how it changed from here to here. And these are the days that are reflective of the Trump rally. Now, this still shows me that longer term, there may be a lot of orders being placed for people to hedge. But look how the numbers change from where they were leading up to the election to what happened post-election in terms of how the sentiment is shifting. Has this gone to outright bullish sentiment? Long term, it hasn't. It's kind of stayed neutral long term, or at least awfully close to neutral long term. These numbers are neutral long term. But look how the sentiment shifted from being really nervous and a lot of hedging going on leading up to things, and how much that shifted. It hasn't shifted into full-on bullish sentiment, but it's certainly, the direction has definitely changed. So let's go back. Let's go back now. And remember, this is one piece of information that we need to have in context with everything else. It's one piece of information to put in context. And it's definitely changed to a more bullish direction. It hasn't gone to an outright bullish sentiment, but I think even with this rally that we have had in the past week or so, and obviously to those people listening to this presentation a couple days from now, a week from now, you know that we're about 1 week post Donald Trump being elected as our new president. And look at the shift that's taken place. The uncertainty has kept it from going to an outright bullish sentiment, but it certainly reversed from how bearish it was. And again, this is one piece of information in context of the whole picture. Don't ever forget that. Okay, here's another example. Sentiment through the early part of January of this year. Look at how bearish that sentiment was, and what was it coinciding with? A pretty big sell-off in the market at the first of the year. Now, there's another way to measure sentiment. We looked at put-call ratios, and we're still focused on put-call ratios. But notice in this case, the number of put orders is substantially larger than the number of call orders at the same strike price. And this is, at the time this screenshot was taken, this was near-term sentiment. Very bearish near-term. On the same company going a little bit longer term, you had the opposite. You had a more bullish long-term sentiment. Now, let me back up. I got ahead of myself and changed screens before I wanted to. What is the importance of looking at near-term and looking at long-term? It depends on the trade you're doing. What is the purpose of any of this? What is the purpose of looking at any of this? What's the reason why we're going to look at any of this? Because we're getting ready to place a trade, right? We want to put on a trade. And when we're looking at this trade, when we're placing the trade, we want to have the best information we can possibly have to take advantage of what's going on. And if our trade is something longer term, like a collar trade, we may be a little more interested in the long-term sentiment. If we're doing a spread trade that's going to expire in 2 or 3 or 4 weeks from now, we may be a little more focused on where are people leaning short term. Because I don't want to buck the trend of what's going on short term. If the market is leaning very strong in a bearish direction short term, I've got to add that. So here's short term, very, very bearish sentiment. I mean, this is a big difference on this particular company in what people are thinking short term. Now, when I put that together with the stock charts, and when I put that together with my recent news on earnings and my recent news politically and on a broader scale, it's one more piece to help complete the puzzle. It's just one more piece to help me complete the puzzle. And I may be warned off a little bit if this particular piece contradicts everything else I'm looking at. if this piece contradicts everything else I'm looking at, I may pause just a little bit on what trade I'm going to do. Okay, so Mary Lou asked the question, what does it mean when one strike price shows a larger number on the put side and the next strike price shows a larger number on the call side? For measuring market sentiment and for measuring, trying to gauge whether there's a little more bearish or a little more bullish sentiment, what I'm going to look at is the option that is nearest to the money. What it means is that there might be a few more risk takers. Now, if you look at this particular one, in almost every case, with this one being the exception right here, at every other strike price we're looking at, there are more put options, and so you see a consistent pattern here. This one's a little bit of an exception. And then when you go deep in the money on the put side, this one changes. I wouldn't read too much into that. That's way out of the money. I just wouldn't read a lot into that. It's so far out of the money that it's not concerning me. I'm looking at what's closest to the money, and I'm hopeful to see some consistency, that everything that's close to the money is kind of telling me the same picture. If it's not, then I've got to look at that and say something is going on that maybe is beyond my understanding. Something is going on that maybe requires some more research on my part. And again, it's one piece of the puzzle. It may not be enough to dissuade me from doing the trade, but it's a piece of the puzzle. Same thing here. You've got some consistency here with the call side being stronger, but you do have one strike price where the put side is stronger. Once again, I'm not going to read too much into this because this is the one that's kind of different from everything else I'm looking at. So let's talk now about the VIX. Again, one more piece of the puzzle. One more piece of the puzzle is the VIX. The VIX is a volatility index. And the VIX will almost always move up in bearish markets, and it will almost always move down in bullish markets. The VIX gives us a measurement of overall market volatility, and there tends to be more volatility in bearish moves. Do strong moves up tend to scare people? Some people call the VIX the scare index. It measures how much, or the fear index. It measures how much fear is in the market. People are more afraid when the market is going down, generally speaking. Now, there might be individuals who are positioned in a very bearish way, and it might scare them a little bit when the market is going up, but that's not going to be the general sense of what's going on. The VIX is typically going to measure fear. During this time period right here, and this is January of 2016, the markets were selling off, and the VIX skyrocketed up. When the markets were recovering, and they made a fast recovery, the fear was going down. I actually think it's appropriate to look at the VIX and think of it as a fear index. Now, let's keep moving along. We're trying to measure overall market sentiment. Look at general market conditions. When you're looking at technical indicators such as the 5 and 20-day EMA or the RSI or the MACD to see if a stock is moving bearish or bullish, look at the same indicators on the indexes, whether it's the S&P, whether it's the NASDAQ, whether it's the Dow. See if the indicators on those indexes are telling the same story as the indicators on the stock you're looking at. And always remember that even though the Dow Jones Industrial Average only measures the 30 largest companies, no, I shouldn't say largest. I keep leaving this in here from one time I do this class to the next. This should just say measures 30 large companies, not the largest, but 30 large companies. And it tries to give somewhat broad spectrum of different industries. Historically, 85% of all publicly traded companies will follow the lead of what the Dow Jones Industrial Average is doing. So you can't ignore that. You can't ignore the relevance of that. If the Dow is giving us bearish technicals and the company you're trading has an 85% chance of following, how confident are you that the company you're trading can buck the trend? If you're going to trade a stock that's moving opposite of what the general markets are, you better have a compelling reason to do it. If 85% of companies follow the Dow, that means 15% will not follow it. And on any given day, it can be a different 15%. There's not certain companies that always go against the Dow. There's not certain companies that always go against the NASDAQ. It can be different companies on different days. So make sure you have a reason for trading contrary to what the markets are doing. Think about the recent events and the effect they've had on the market. Wars, hurricanes, political contests, scandals, business scandals, political scandals. All of these things can have an effect on what the markets will do. You don't necessarily have to be a news junkie, but you have to pay attention to what's going on around you and place your positions accordingly. Let me give you a recent, real example. Many people, myself included, many people thought going into the election last week that if Hillary Clinton won, we would see a short-term surge in the market, and longer-term the markets would be more bearish. And they thought the opposite. If Donald Trump won the presidency, they thought we would see a short-term fall in the markets and a longer-term move up in the markets. And it's just based on the different philosophies on economic policy. Nothing, politics aside, I guess technically it's not politics aside, but your personal political feelings for the two candidates aside, that most people were in agreement that short-term Donald Trump would cause the markets to sell off. It hasn't happened. It's been just the opposite. But what has happened is that long-term sentiment and the longer-term feeling that his economic policies will help small businesses and large businesses and help the economy grow have had a very strong effect on the markets this past week. Can it continue? Well, we'll see. We don't know. But we've got to pay attention to these things. News events will oftentimes only affect a stock's short-term movement, but bigger global events can put major pressure on the stock markets. It is possible that we're still going to see what we thought we would see with Donald Trump, and that is, it's still possible that we get a sell-off until his policies actually start to take effect and take hold. It could be that we look back and say, all right, there was that little blip in the week following the election, but we still had a sell-off early after his getting elected, and then longer term have a move up. I don't know. It could be that what we're seeing this past week is the beginning of a longer term bullish move. The point is, we just have to pay attention to what's going on. We can't live with our head in the sand. Measuring sentiment analysis is like trying to gauge the pulse of the market and the investors who are ultimately the ones driving prices. It's not an exact science. You need to be clear on that. It's not an exact science. It's something we have to pay attention to, but we keep it in perspective. Sentiment analysis, like other indicators, needs to be looked at in the big picture, keep the forest view, and put into proper context. And that's basically our little lesson/lecture on sentiment analysis. Have a great week, and we'll see you next time we do a live class. Thanks, everyone. Bye-bye.